In today's video, we're going to cover the 5 worst investments that I see on a regular basis meeting with retirees from across the country. Most retirees are investing to prepare, get themselves in great shape for retirement. And so having poor investments in your portfolio is something that's going to hold you back, and it's going to reduce your chances of maximizing your retirement income, meeting your other financial goals, and retiring early if that's what you're trying to do. So make sure to stay to the end, because I'm going to explain why each of these investments usually don't work out for clients, and frankly, some pretty simple alternatives that you can explore that are low fee, easy to understand, to improve your overall investment situation for retirement. So without further ado, let's get right into the video. As you can imagine, having a YouTube channel, I meet with a lot of people from across the country, and I see common themes for retirees. Most people want to maximize their retirement income, and so they're proactively investing and often, proactively searching for things that they think are going to improve their overall situation. There's a lot of new financial products that come out all the time, but in this video, I'm going to go over the 5 that I see most often because, frankly, I see them most often. I think they're the most common, and I did some extra research to get into the details of why these particular investment products are not well suited for retirees. So the first investment that I want to talk about is the variable annuity. Now, if you have annuities, I don't want you to feel bad about this. Frankly, it's always interesting. One of the things that people ask me when I meet with them is, how do I compare to other people? Or am I in pretty good shape? Or what do you think? And it's my experience that even great investors and people that are well prepared for retirement often have a portion of their portfolio invested in things that are not that great. And one of those, most common one, is the variable annuity. One of the issues with a variable annuity is its fee structure. Internally, these products charge anywhere between 2 and 3% per year for investments that you can get easily outside of an annuity contract. So you're investing in things like, the S&P 500 or international stocks, real estate. All of these types of investments are available to you outside of a variable annuity wrapper. So why are they so appealing? Why do so many people have them? Well, the first reason is that I believe these products are sold, not purchased. Usually people are approached by some supposed financial advisor who is convincing them that, hey, this is a way that you can be invested in the market and have some guaranteed minimum income or some guaranteed, rates of return on top of just investing in the market. And for most people, having some kind of sense of security or, an insurance company kind of standing behind their investment portfolio is something that has a lot of appeal to it. At the heart of it, though, the reason why these contracts get pushed a lot is because they pay really high commissions. So an advisor selling one of these contracts could be earning anywhere between 5 to 10%. In my experience, usually 7% is the commission that I see advisors earning on these contracts. And you have to understand that when they sell one of these contracts, they're earning that commission right up front. So, they talk you into, putting $500,000 of your portfolio into this annuity to tell you, hey, this is going to protect your money. It's got this guaranteed income, et cetera, et cetera. Right there, they're walking away with maybe a $35,000 check. Now, let's say you change your mind 6 months later, a year later, and you say, you know what? This is not what I thought it was. It's not performing like I thought it would. Or, you know what? I never really even understood how it worked in the first place. I just kind of got caught up in the thrill of, guarantees, et cetera. Well, if you change your mind, the other issue with these contracts is they have surrender penalties. Not always the case with every contract, but usually the way that it works is that if you decide to end your contract and transfer your funds to a different account, you're going to pay something in the neighborhood of 10%, because at the end of the day, the advisor is going to keep his commission. The insurance company, they're not going to be out any money. It's you, the customer, who's going to miss out. You're the one who has to pay that, even if you didn't even totally understand maybe what it was that you were buying when you signed up for that contract. Looking at data from both the SEC and from FINRA, 2 regulatory agencies that are in charge of overseeing this type of, these types of investment products, there were over 400 arbitration cases in 2022 and 2023 of customers, clients, just like yourselves, retirees, filing complaints to the authorities about buying one of these products and not understanding, what it was that they bought in the first place. And in a survey, 68% of advisory firms showed that selling variable annuities was their most profitable investment product that they would sell to their clients. Another really troubling issue with these things is that what I've seen personally is that when some financial advisors will sell a variable annuity, they'll say, hey, you know what, this is a great product. It's got all these great features that get you invested. And then at the end of, after 5 or so years, they'll go back to the client and say, hey, you know what, this is a pretty good contract, pretty good annuity, but we need to get you into a different annuity because it has better features, et cetera. And so they will get the client to move their money from the first annuity to the second annuity. Now, why do they do that? In my opinion, most of the time, it's because they already got paid a commission up front on the first contract. And so for them to get paid again, they got to move you into a new contract. This is called churning. It happens all the time. And so if you're in a situation where you've seen this with your advisor over the years, where at first they sold you an annuity, and then it seems like every 5 or so years they come back to you with, hey, I've got this better annuity I got to sell you, then you're probably in a situation where your advisor is looking out more for their commission than they are for your financial well-being. The second investment that I want to talk about is the fixed indexed annuity. I would say this is even more popular nowadays than the variable annuity. It has all the same problems that I talked about with the variable annuity. And in that, what I mean by is they have the same type of structure where the person who sells it gets a big upfront commission.
We need all the sales we can get.
There's surrender penalties if you change your mind, so that the insurance company doesn't lose out, and the person that sold it to you gets to keep their commission. You're the only one who loses. I would say they're even, most of the time, I see even kind of worse situations with these contracts because there's a little bit of I'd call it a regulatory gap within fixed index annuities. Technically, they don't have to be sold by somebody who is licensed with the SEC or with FINRA. They don't have to be sold by a financial advisor. They can be sold by an insurance agent because they're technically an insurance product. Even though they kind of walk and talk like a duck, technically, they're not a duck.
Walks like a duck and quacks like a duck. It's a duck.
They're just insurance, right? So, and in my experience, insurance agents, there's just a lower bar of entry to enter to become an insurance agent.
You just think everything and everyone is dumb, huh? Because you're a nihilist.
It's nihilist.
And so these products, they pay really high commissions, and so they get sold to a lot of people. Now, usually the way these are sold is with some type of sales presentation that, hey, this is a way that you can earn money tied to the market with zero downside. Now, what's not talked about this as much when these are sold is opportunity cost. You rarely do these contracts keep up with inflation, even when they pay sign-on bonuses, which is a very common feature. I'll often see retirees say, hey, if I buy this contract, I'm gonna get a 10% upfront bonus or a 20% bonus on my contract. These bonuses really only take effect if you hold the contract for some minimum of something like 10 years. It's different with every contract, but that's kind of a general structure. And in the meantime, the rates of return that you're receiving are so low that when you look at like a 10-year period of time, you would have been better just owning, maybe even owning a portfolio of treasury bonds. You could have had the same or even better rate of return with a lot more flexibility. So that's the second worst investment on our list. Now, the third investment I want to talk about is a product that I have a lot of experience with. When I was in college, I worked for a firm that sold a lot of these things. I don't want to out their name. These types of products used to be more popular. From my experience, I still see a lot of them, and that is a non-traded REIT. Now, a REIT is something called a real estate investment trust. It's not exactly the same as a mutual fund or an ETF, but essentially it's a portfolio, but instead of owning publicly traded stocks and bonds, it owns a portfolio usually of commercial real estate. Now, when we say non-traded, what that means is this is a fund that you can't just buy or sell any day, through your Charles Schwab or Fidelity or Vanguard account. You can only buy into it at certain times, and you can only liquidate those funds at certain times. Now, the reason why these get pushed so heavily is because, in my opinion, the same thing. They pay very high upfront commissions to the advisor who sells it to you. Now, one of the things that an advisor would say is, hey, we got to get you diversified into real estate, not just regular stocks and bonds. Well, if that's the case, there is plenty of other ways to access commercial real estate through liquid and lower cost investment vehicles like ETFs or just regular traded mutual funds. And if you look online, lots of the big, investment houses like Vanguard or Fidelity or Charles Schwab have ETFs where you can access broadly diversified portfolios of real estate for very low cost. I'm not making endorsements of any investments here. This is not advice, but just kind of generally helping you understand the landscape of these investments. Another issue with these investments, in particular, the non-traded REIT, is the idea around dividends. Oftentimes they'll market, oh, this pays a really high dividend. But often what's happening, especially in the early stages of a non-traded REIT when you first buy in, the fund has not deployed that money to invest in real estate yet. So the supposed dividend is really just a payout often of your principal They're paying back to your principal. And so it seems like, oh, I'm getting income, but actually they're just paying you back your principal. Not always the case, but it's often the case with non-traded REITs. Other issue with non-traded REITs is that if you need your money, there's often, long lockup periods of time where they can restrict when and how much money you can get out, which can stop you from, or can make it difficult if an emergency happens for you to be able to access your funds and use them the way that you need to. The next investment I want to talk about is the non-traded BDC, which stands for Business Development Company. Now, this is similar to a non-traded REIT. It's another privately managed investment pool of funds, but instead of investing in just traditional real estate, often these funds are making private loans to mid-sized companies. And so often you'll be sold the pitch of, hey, you know what? Medium-sized corporations, they have difficulty accessing the bond market like big corporations. And so this is a way that they can borrow money for their businesses, and you can earn as an investor higher rates of return, higher rates of interest. Well, although that's technically true, they hold all the same issues that non-traded REITs do, which is when the fund is opening up, before loans are made within the portfolio, oftentimes you're getting just return of capital. You also have gated withdrawability. So you may not be able to actually access your money until a certain period of time, or if you're able to access your money, you're restricted based on a percentage of the fund. So if there's a lot of people within the fund, like let's just say during like difficult financial times, trying to access their money, the fund can actually gate and restrict your withdrawals completely legally because it's something that was deep down in this big thick disclosure that probably didn't read, and they can restrict your funds so you can't access them.
I have no other choice, okay? This is the only rational way I know to prevent this tragedy.
On top of that, BDCs also have very high internal fees, similar to non-traded REITs, so you're paying a lot more to, essentially own a bond, than you would if you just owned that through an ETF or just bought bonds directly, which you can easily do on most investment platforms. And finally, with BDCs, it's another investment vehicle that has just a really checkered history of regulatory issues. It's one of the most common complaints that happens in the arbitration courts with FINRA and the SEC is with BDCs. And in fact, let's see, back in 2023, there were 92 arbitration cases related to business development company investments. So another one of these investments that sounds really great, again, sold by advisors who earn a big commission, and of course the devil is always in the details. For the last investment, this is by far the very worst retirement vehicle that I have seen, and unfortunately it is way more common than it should be. And this is the IUL, the Index Universal Life Insurance Contract. These contracts hold a lot of the same issues that I've talked about with these other investments. Namely, they're sold by professionals who earn a large upfront commission. They are very complex in nature. The way that you earn money within the way that you're able to kind of grow your money with these is very opaque. It changes from year to year, and they're often sold with the idea of guarantees or tax-free income, and it's rarely the case. Essentially, the way that an index universal life insurance contract works, you buy a life insurance contract, you can put money into it, and you can put extra money into it above kind of just your regular insurance premium, above the amount that would be needed to cover, to pay for your death benefit. And that money is supposed to accumulate in this, this cash value of the contract. Now, that cash value is the way that it's marketed is that it's linked like a fixed index annuity. It's linked to market indices like the S&P 500, where you can participate in some of the upside of the market while avoiding the downside of the market and hopefully earn, really great returns. Basically, be able to have your cake and eat it too. Now, the additional sales pitch for these contracts is that it's a way for you to access tax-free income in retirement, which, as you know from many of the videos that I make, I'm talking about ways to do effective tax planning in retirement and how important that is for affordable health insurance and all sorts of things. You'll notice that I've never talked about these magical index universal life insurance contracts as a way to accomplish that. And simply it's because they don't work. And I have morals. So I am not going to talk about something that I know is garbage. I'm being a little more candid in this video, frankly. But index universal life insurance contracts are, in my opinion, the very worst retirement vehicle that is common among retirees, among millions of retirees in the United States. Again, sold by insurance agents with a lot of promises or, kind of implied implications of, that they're going to be so great, and they rarely are. I have seen dozens and dozens of these contracts up close, personally, with clients, and I've never seen one that performs in the way that the projections the client was given when they initially bought the contract said that they should perform. So what always ends up happening with these contracts is that they don't perform. The performance of these underlying indices never pans out in the way that they're hoping. And so what happens is the insurance costs just keep going up and up and up every single year. That's how they work by design. And the cash value can't grow enough to be able to cover the life insurance premium and build a cash value for you to, presumably borrow against in the future for this tax-free income stream. And in fact, one of the issues with these contracts is that in retirement, let's say that you did manage to build up a cash value that you can borrow against for tax-free income. If it ever happens that from borrowing funds from this contract, the policy goes into default where, you can't cover the cost of the insurance, the contract, it can end up blowing up and you end up having to pay taxes on any gains that you had. But don't worry, you probably won't have any gains within the contract, so that's not the issue. But the real issue is that you then lose what, is the most important part of a life insurance contract. You lose that death benefit, which, for retirees later in life, where, a spouse has a contract like this, having a death benefit is something very valuable to the surviving spouse. And so, using these as retirement income vehicles that you borrow against really can put you in financial jeopardy where all of a sudden you are weakening the very financial instrument that could provide financial security for your surviving spouse. Again, they're very complicated, underlying how they work. The returns are not guaranteed. Yes, you can lose money because you have the embedded cost of the insurance within the policy. They can blow up, end up losing the contract, and the returns are rarely the way that they're projected. Again, in my own experience, I've never seen one perform like the way that people hope. And so now, not to worry, because if you ever change your mind when you have one of these, again, you have big surrender penalties if you ever decide to cancel the contract before the surrender period is over. So hopefully this is helpful to understand what the worst investments are for retirees that you should just basically avoid. Now, if you own any of these types of investments, or you think that you might, I would strongly caution you against just going and canceling these policies or investment contracts. Because like I said, embedded in each of these are surrender penalties and a lot of technicalities. And so before you do anything like that or even consider it, you should walk through it with somebody who can do a deep dive on your particular contract or policy or investment to help you understand the implications of what would happen if you did that, or maybe how to do it in a way to avoid penalties and taxes and other issues. Now, like I talked about in the beginning of the video, are there ways to, access tax-free, income in retirement? Yes. Is there ways to access parts of the investment world beyond stocks and bonds like real estate? Yes. The thing is that you can do these all through very low cost, transparent investments like exchange traded funds or mutual funds that are available to anybody to purchase on large platforms with a lot more transparency, with longer track records, and with companies that are larger and have a better reputation for, delivering on what they promise. So hopefully this video has been helpful and can help you avoid some of the biggest investment mistakes that I see every single day meeting with retirees from all across the country. If you'd like some help looking at any of these types of situations for your own retirement, or looking at your overall retirement plan to see if you're in the best shape that you can be in, click the link in the description and I'd be happy to meet with you to take a one-on-one look at your own situation. So until next time, wish you the best, and I'll see you later.